Welcome to Ahead of the Curve from K33 Research. Today is June 9th, 2026. A written version of today's analysis is available on K33 Research. In this episode, we'll examine Bitcoin's recent move below $60,000, the record ETF outflows, extreme bearish sentiment, and why several indicators that have historically appeared near major market bottoms are now flashing simultaneously. While market conditions remain challenging, the balance of evidence is becoming increasingly difficult to ignore. Bitcoin briefly traded below $60,000 last week, setting a new cycle low and falling beneath its 200-week moving average. More than half of Bitcoin's circulating supply is now trading at a loss, while the daily RSI reached its lowest level since November 2018. At the same time, Bitcoin ETF investors continued to sell aggressively, producing the largest 4-week outflow period ever recorded. Despite these developments, several long-term indicators are now moving into territory that has historically been associated with major market bottoms. Over the past 4 weeks, Bitcoin exchange-traded products have experienced net outflows of more than 85,000 Bitcoin, the largest 4-week outflow period on record. Daily outflows have averaged more than 4,000 Bitcoin since early May, nearly 10 times the pace of new Bitcoin issuance during the same period. This sustained selling pressure has weighed heavily on prices and pushed total ETF holdings to their lowest level since June of last year. At the same time, Bitcoin has struggled to compete for investor attention. Capital continues to flow toward artificial intelligence, semiconductor companies, mega-cap technology stocks, and highly anticipated IPOs. As a result, Bitcoin has remained one of the weaker performing risk assets in recent months, creating additional incentives for investors to rotate capital elsewhere. Despite the weak price action, market activity has increased significantly. Bitcoin spot trading volumes surged 86% over the past week, with average daily volume rising above $5 billion for the first time since February. Volatility has also returned, with 7-day volatility reaching a 3-month high following Bitcoin's decline from $70,000 to below $60,000. Fear has become increasingly visible across the market. The Fear and Greed Index recently fell to 8, a level that has historically been extremely rare. Since 2018, fewer than 1% of trading days have experienced such extreme fear. At the same time, derivatives markets have become noticeably healthier. Last week, we highlighted the risk of liquidation-driven downside volatility as leverage and funding rates remained elevated. That risk has now eased considerably. Open interest in perpetual futures has fallen sharply. Funding rates have normalized, and the risk of forced liquidations amplifying volatility appears substantially lower than it did a week ago. While institutional participation remains weak, speculative excess has largely been removed from the system. The most interesting development may be what is happening beneath the surface of the Bitcoin network. More than 50% of Bitcoin's circulating supply is now sitting at a loss, meaning more than half of all Bitcoin last moved at prices above current levels. Historically, this condition has only appeared near major bear market bottoms. In 2011, 2018, and 2022, Bitcoin reached its ultimate cycle low within roughly 1 month of crossing this threshold. Those periods often included one final move lower, but they were also followed by substantial gains over the following year. History never repeats perfectly, and there are important caveats, but reaching this level has historically coincided with environments where much of the selling pressure has already been exhausted. As profitable holders gradually disappear, fewer investors have gains to lock in, altering the supply dynamics of the market and often marking the transition from capitulation toward recovery. Another important signal comes from Bitcoin's 200-week moving average. No major Bitcoin bear market has ended without the price eventually reaching this level. During last week's decline, Bitcoin briefly traded below the 200-week moving average before recovering. Compared with previous cycles, the current drawdown remains relatively mild, with Bitcoin down just over 53% from its 2025 peak. Previous bear markets saw declines ranging from 76% to 85%. If the recent low ultimately proves to be the cycle bottom, it would represent both a shallower and shorter bear market than those seen in the past. That would also be consistent with Bitcoin's long-term trend of diminishing returns and potentially diminishing downside. Our base case remains that the area around the 200-week moving average near $60,000 marks the cycle low. Whether or not the exact low is already in place, this continues to look like one of the most attractive accumulation zones seen during the current cycle. At the same time, patience remains important. Historical bottoms are rarely clean and often involve significant volatility, false starts, and periods of extreme pessimism before a durable recovery takes hold. To summarize, Bitcoin remains under pressure from record ETF outflows, weak institutional participation, and ongoing competition for investor capital. However, several indicators that have historically appeared near major market bottoms are now flashing at the same time. More than half of Bitcoin's supply is trading at a loss. The price has tested the 200-week moving average. Sentiment has reached extreme fear levels, and derivatives positioning has become significantly healthier. While uncertainty remains high, the expected value increasingly appears to favor long-term investors willing to look beyond current market conditions. Thank you for listening to Ahead of the Curve from K33 Research. Subscribe for future market updates and visit k33.com/research to read the full report and explore our latest research.